the market was down again today. We were down about 21 points at the end of the day. We started out on the upside, kind of trying to get a little bit of a move up. As I wrote about in this last weekend's newsletter, we had come down recently, retested the 200-day moving average intraday last week. We bounced off, and actually, it was interestingly enough, we actually finished the week last week exactly where we started the week. We were actually down 0.01% for the week last week. So, in other words, all we did was just round trip off the 200-day moving average back exactly to where we started, but have still maintained this whole process of this topping pattern, and it's becoming substantially more clear that as we continue to watch this topping pattern in its process, you're watching this very clear arc being developed in prices. And this downtrend that's currently being developed is compressing prices more and more. We failed again right at the top of this very specific downtrend line today and are continuing down this process of making lower highs. Now, that's the bad news. The good news is that we continue to maintain the bottom support here right at the 200-day moving average, but this is going to have to end here at some point very soon. The question is which way is it going to resolve itself? If we get a breakout to the upside, we could have a very substantial rally from that standpoint because of the length of the consolidation, the compressing in prices. Think about a spring. When you press prices together, they tend to coil out on the other side when it's released. So a breakout to the upside could very well take us back to old highs and even potentially new highs in the market. A breakdown, though, below that 200-day moving average is going to be critical here because of that support that's being built. This is where all these algorithmic traders, all these robot traders, they're watching that 200-day moving average. Every time we get there, they start buying. The problem here is that a break of that 200-day moving average is likely to change the dynamic of not only traders themselves, but also these algorithms to where they start selling rallies rather than buying dips. That's going to be one of the major changes that we've talked about many times in our newsletter, particularly when it comes to ETFs. There's so much money hiding in these fairly illiquid ETFs that if we get into a position where robots start actually trading in the other direction, we could have a very sharp gap down in prices. It could happen very, very quickly. So this is why you want to be a little bit careful. Over the last several weeks, we've been talking about using this rally that we've had here. You've had multiple opportunities. You had one here, and here to raise cash. And we've been recommending raising cash on these rallies. Have a little bit of extra cash in your portfolio because that liquidity gives you options. If the market does break out, great. We take that cash, we can put it back to work in the markets. Great, we're making money. If the market breaks down, that cash is going to act as a hedge or a cushion against limiting some of the decline in the value of your portfolio, which gives you an opportunity to start making other changes without doing so from a panicked perspective. And emotional perspectives is where we always make our worst decisions on portfolio management processes. So now, one other thing here, interest rates. Interest rates have been actually tracking with the markets here as of late until today. We actually saw rates over the last couple of weeks actually moving in tandem with the markets. If markets were moving up, rates were moving right along with it. Today, we actually saw the reversal of that, is that markets were down and actually interest rates actually moved in a positive direction. Bond prices were up, interest rates were down. So we actually saw an improvement today in bond prices, money flowing out of risk, out of equities into safety, and we're continuing to see that safety trade occur. We're also seeing it in other areas of the markets as well because we're watching better performance coming out of sectors like utilities and also out of an area like consumer staples have also seen a bit of increase here. And like I said, if you take a look at utilities have had a very nice rally here over the last couple of weeks in particular as money's been looking for that rotational trade. So pay attention to some of these out of favor sectors. They've actually been picking up money flows as of late. So when you start talking about portfolio allocations, that's important. Okay, one other thing I want to show you here real quick is from this weekend's newsletter. And again, if you read our weekly newsletter, all this stuff is in the newsletter. It's absolutely there for you already. And one of the things that we talked about this week was this continuation of this consolidation pattern in the markets. And when you start talking about this consolidation, there's just a whole cluster of areas where this market can move out from here. And that's the problem here, is that there's so many possible solutions that where this market can head to, it makes it very difficult to say this is exactly what's going to happen. I got a lot of emails today saying, well, can't you just pick a direction? Well, I don't know if the market's going to go up or go down, and we won't know until the market actually decides what it wants to do. And until that time comes and that market makes that decision and we break out of this consolidation or we break down out of this pattern, it's best just to have some extra cash and just wait for the markets to tell you what it wants to do. If you have some cash and you've got some fixed income right now, reduce your level of equities. That gives you plenty of ability to sit around and just wait for something to happen, and then we can make a much better decision. But here's the problem. If we try to guess at what this market's going to do next and try to make an assumption that this market's going to be either bullish or bearish, there's a 50% probability you're going to be wrong. And the problem with being wrong here is that when you're wrong at this point of the measure, the potential of being wrong to the downside is going to heavily weigh potentially on your portfolio. So that's why it's not worth betting. Right now, the better bet, literally the better bet, is simply just to wait and allow the markets to tell you what it wants to do. There'll be plenty of time to make a change after the fact. If the markets do break out to the upside, that's going to be right around 2750 on the S&P 500. We'll add some money, so you're going to miss about a point of the advance. If the markets break down below the 200-day moving average, which is right around 2,600 right now, then you're going to lose maybe another 1% to the downside before being able to swap everything out of your portfolio. So your risk up or down is about 1%. In the grand scheme of things, that's not a whole lot of risk. So just pay attention here, because making a big bet is going to lead to a wrong outcome in potentially a lot of cases, and that's going to be worse for your portfolio than just being patient and waiting.
Fast world.